what we're going to be going over here is cost, volume, profit analysis, where we're going to be looking at the effects of sales mix on income. And what we mean by sales mix here, this is where we're selling multiple products here and we're grouping them together here, and we're having to determine some operating income or some income on those multiple product sales, and we're also going to have to allocate some fixed cost over those multiple products that we're going to be selling. And for our example, we're just going to be looking at two different products here, product A and product B. So we're going to have sales here for both of those products, and we're going to have to determine some operating income here. And first we're going to look at a break-even point for those product sales here, and then we're going to look at some budgeted sales, some operating income for some budgeted sales, and then we're going to compare it to some actual sales that we had. Okay, so what we have to start with here is this operating income equation, but what we're going to have to solve for is the quantity sold here on this operating income equation. And this is where the sales ratio comes into play here. So we're going to have those two products here. Product A, we're budgeted to sell 15,000 units here, product A, and product B, we're budgeting to sell 5,000 units. So sales ratio is simple enough here, 3 to 1. That is, you can see it here, 5 goes into 15 3 times here, so we're going to sell 3 times as many at product A here as we do product A. So product B, excuse me. So sales ratio here is 3 to 1, and this is going to come into play for us. Okay, so going back to our operating income equation here, and we're going to be solving for the quantity sold here for both of those products. So starting out with our product A here, we're going to have a selling price at $2 per unit, variable cost here $1.40 per unit. So that's going to give us a 60 cents per unit here contribution margin. Now this is where we have to put in that quantity sold. And that's based on that sales ratio, 3 to 1. So we're going to solve here for Q for our break-even point here at 0 or 0 operating income. So plug it into our equation here. Sales ratio of 3, we get 3Q here for product A here. Now for product B, we're going to have a selling price here of $3 per unit, variable cost of $1.80 per unit. But this is, and for a contribution margin here, $1.20 per unit. But for the quantity sold, go to our ratio here, a ratio of 1 here for B here. So Q is just the 1 unit. 3 here for product A, 1Q here for product B. And then our fixed cost here we're going to use for our example is $12,000. We have to subtract that times our quantity, and now we can solve for Q here. So what we're going to do here is move our 12,000 over here to this side of the equation here, and our Q, well, let's see how we got that here, just so you understand what's going on. It's going to be $3 here total contribution margin here for what they call these both products that we're selling. So 3 times the 60 cents here, what does that give us? $1.80 plus 1 Q here times $1.20. So total amount here, contribution margin is $1.80 here, $1.20 here, $3. So $3 here times Q is going to equal our moving our fixed cost here over this side of the equation. So just dividing Q out here, we're going to get Q is equal to 4,000 here. So this is the case here where you're going to have to go to that ratio again. So Q here is 4,000 units here. That's for product B here. And that's going to be 4,000 units here, product B for the break-even point. And then 3Q here, well, 3 times 4,000 here is going to be 12,000 here for product A. So product A is going to have contribute here 12,000 units to the break-even point here for, and B contributes 4,000 units. So just using our formula, our operating income formula, and solving for our quantity here based on our sales ratio, we come up with those numbers here. 12,000 units of A here and 4,000 units here of B for that break-even point. Now, we could have looked at it in a second way here, looking at it. Simply to determine our break-even point, we would have taken our $12,000 here in fixed costs that we have and just divided by that contribution margin here per bundle here. And that was, what, $3 we calculated. 3 here, 3 quantity of 3 times that 60 cents per contribution margin for A plus 1 here times $1.20 for B. So that's where we got that $3 here. That's the contribution margin for what they call a bundle here. And a bundle is really the grouping here between products A and products B, or whatever multiple products that you'd have. We're just looking at 2 in this case. So just taking our fixed cost here, $12,000, divided by that contribution margin here, $3, for the total bundle here, as they call it, that's going to give us 4,000 bundles. So had we not solved for Q here, we could have just gone and taken this equation here, had the 4,000 bundles, and just worked off our sales ratio here, that 3-to-1 ratio. So 4,000 bundles, that included 12,000 here of A, that was that 3,000, or 3 times the 4,000, or the one bundle, or 4,000 bundles here equates to 12,000 here of A and 1,000 or 4,000 here of B, and that's based off that sales ratio. So we could have figured it out this way here, that break-even point. Break-even point here is have to sell 12,000 units of A, 4,000 units here of B. Okay. So we could have gone either way here, just did it in 2 different ways. Now let's go down and let's look at a cost volume profit graph here. Lay everything out here. This is where we're showing our units sold here on our x-axis, across our x-axis, across our y-axis here. That would be our operating income. So just starting with that fixed cost, we have a negative operating income here of $12,000. So we have to cover that here before we generate any operating income at all. And those are generated here based on our sales here. And we're going to look at 2 different profit lines here. So I'm showing it in sort of the brownish line here. That is for that those product B here. And and this is the case where the contribution margin is $1.20 per unit. And then the green one here is for product A. Contribution margin here is 60 cents per unit. So what we're talking about here in contribution margin here, for every unit we sell here, product B, $1.20 will be going towards operating income for each unit we sell. So you can see here, product B has a much steeper profit line here. So and this is where the sales mix comes into play here. So if you sell, you have to sell a whole, for just looking at your steepness of the line here for product A here, that's that 60 cents per unit. In this case, you have to sell, for every unit you sell of product A, 60 cents here goes against operating income. So just looking at the steepness of the lines, you can see here where the sales mix comes into play. So if you'd have to sell a whole lot more here of product A based on its contribution margin here than you would of product B to generate the same operating income. And vice versa here, you'd sell less of B here to generate the same you'd have to sell less of B here to generate the same operating income had you sold more of A. So really they work in that direction here. So let's just look at the case here for those break-even points here. So remember, break-even point here for B, those were 4,000 units that we sold here, and we'd have to take that times what, $1.20 per unit, so we get 4,800 here in operating income break-even point. And then moving over to product A, those were those 12,000 units that we had to sell here of product A times 60 cents per unit. You're going to come up with $7,200. So just taking those 2 amounts here, adding them together, you're going to come up with $12,000 here in operating income, but then you had to cover that fixed cost here, $12,000 here in fixed cost, so you end up with 0 operating income here at the break-even point. Now let's just go up and let's look at those budgeted sales. Okay, so this is the case here where we had for A here, we had 15,000 units budgeted times the 60 cents here contribution margin per unit. That's going to give us 9,000 here in income here that we're looking at. And then for B here, well, what do we have? We had 5,000 here units that we plan on selling here, budgeting, times $1.20 contribution margin here. So that gives us 6,000. So then we have to subtract out our fixed cost here, $12,000. That's going to give us an operating income here of $3,000. Just going down onto our graph, laying that out onto our graph here, those 5,000 units here of B here that we're selling at $1.20 per unit is going to give us 6,000 here in operating income. And then for those 15,000 units here of A that we're selling here, Take that times our contribution margin here of 60 cents. That's going to give us what, 9,000 here in operating income. You can see, just laying them out here, just you take your units that you sell here times the contribution margin, and that gives you your operating income. I just laid these out here, understanding this profit volume line here and how it really affects our operating income. Steeper the line here for product B here, contribution margin is $1.20. So that's what each unit that you're selling here adds more operating income here based on product A here. And that had only that 60 cents contribution margin per unit. So pays to sell a whole lot more here of product B here than it is product A. You have to sell a lot more of product A to equal any profit that you'd have here based on lesser sales here for product B. Okay, so you understand what's going on here. Now let's just go up and let's do our comparison. Okay, so we had our budgeted amount here, our sales ratio. That was A here, 15,000, or a 3-to-1 ratio here. That was what we had on our budgeted amounts here between A and B. Now we look at our actual sales for the period. We have to determine our sales ratio there. This is the case here where we're budgeted to sell 15,000 here of A. We actually sold 18,000 here of A here. But in product B, we were budgeted to sell 5,000. We actually sold only 2,000 units here of product B. So our new sales ratio here is now moved from 3-to-1 to 9-to-1 here in favor of product A here, essentially. The 2,000 going into 18,000 gives us 9 here for a ratio of 9 here for A. So we're selling 9 units of A here for every 1 unit we're selling of B here. So 2,000 units here of B that we're selling on our actual for our actual figures here, 18,000 units of A, 9-to-1 ratio. So, and if you note here, so for product B, just to note, we were budgeted to sell 5,000. Now we actually sold 2,000. And for A, we were budgeted to sell 15,000. We actually sold 18,000. So A's number of A's product A here has increased, and B has gone down. And that's going to affect our change in our sales mix is going to affect our operating income and also the break-even quantity. And you note here that we have the same quantity in both cases, 20,000 units. For the budgeted amount, 15,000 plus 5 is 20,000. For the actual amount, 18,000 plus 2,000 is also 20,000. That's just for our example that we're going through. Now, if we go through and let's just solve for Q again using that operating income equation that we have. So just plugging our numbers in here. Our ratio here for A, remember, sales ratio of 9. So we're having so for our quantity that we're solving for A, we're putting in 9Q here, and for B, well, there's only a 1 sales ratio here, 1, so we just put in 1Q. So just going through and solving our equation again here, well, for product A, we're going to have 60 cents contribution margin here times 9Q. That's going to give us what? $5.40 here for product A contribution margin. And then for product B, $1.20 times 1Q here. So looking at our total contribution for both products here based on that new sales ratio, we're going to come up with $6.60 here for both of those products as our contribution margin times Q. That's going to have to equal those fixed costs. We move that fixed cost over this side of the equation. So we come up with Q here, divided out here, 660 into 12,000. We're going to come up with what we call bundles here, or Q is 1,818 units here. That's what we call that bundle again, or a grouping between A and B here. So Q here for B, we can figure that out here. It's only 1Q here. That represents, well, 1Q is 1,818. So that's how many units of B that we're going to have to sell here for that break-even point here, 1,818, and then 9Q here for B, or for A, excuse me, product A. That's 16,363 units here. So we could use this sales ratio here, just using that sales ratio. That's how we came up with Q. We could have also looked at that fixed costs and contribution margin here per bundle and gone on gone on in that fashion. But the bundles here, that's 1,818 here for Q. Then you have to go back to that sales ratio and do your multiplying here to determine your actual sales. So our bundle here, that this 1,818, what we call the bundle or the grouping here, is comprised of 16,363 units of A that we've sold here and 1,818 units of B, based on our sales ratio that we have. And total amount here that we would have sold is 18,181 units. Okay, so now let's go down and let's look at our cost volume profit graph here. Same as we had here before here. B here, $1.20 contribution per unit. Product A here, 60 cents. So just going, all we really want to look at here is those actual sales versus our budgeted sales, and also look at those break-even quantities, how they change. So for our actual sales here, we have 18,000 units of A here times 60 cents per unit contribution. That's going to give us $10,880 here. And we can go down to our graph here and look at it. So those are 18,000 units here times the 60 cents contribution margin per unit is going to give us 10,880 here in operating income. And then we've had that for product B here. What was that? That was 2,000 units here times $1.20 per unit here for product B. That's going to give us 2,400 here in operating income. So that's down here, 2,000 here, and that's on our brown line here. And that was 2,000 here times $1.20 gives us operating income of 2,400 here. But we have to cover those fixed costs here. We still have those fixed costs of 12,000 here. So going up to our actual sales here, subtract out from those sale amounts here that we have here, we subtract out the 12,000 here in fixed costs, and we're going to get operating income of $1,200. So really what we want to do is we want to just look at that, compare it to what our budgeted sales were. Remember, we determined, just looking at our numbers here, for our budgeted sales, we determined our operating income to be $3,000 here. Versus our actual sales, we're now sitting at $1,200 here in operating income. Again, after we subtracted out those fixed costs. Okay, so what you're seeing here is we're having a lower operating income here based on that sales mix. And the fact is, looking at our we're going back to just the contribution margin lines here, or our profit lines here between A and B, and it's just common sense is telling us here. Fact is, we've moved our sales down here. What we had somewhere around 5,000 units here for B, so that was it was contributing at a greater contribution margin here of $1.20 here per unit, or $1.20 contribution per unit sold. Now we move down to 2,000 here. So it generated less operating income, fewer units sold based on that sales mix going down. And then for item A here, product A, again, our volume did go up, but our contribution margin here is less at 60 cents per unit. But again, that's where we originally had 3Q here. Now we moved up to 9Q here for A and 1Q for B. I misstated it here. It should have been 9Q here for A at this point. But you just looking at here our operating income, budgeted sales, because we were budgeted greater amount here for B, and the contribution, because it had a greater contribution margin here. Now we're down to a lower amount here, so that's dropping our operating income down here. Okay, so you can see the logic here. Pretty simple logic here, but when you're dealing with these multiple products, you have to look at what each one, this actual sales on each one here, and how they're contributing to the income. So if you're ideally, you would like to be selling a whole lot more here of product B here because it has a greater contribution margin here than product A. But you can see it can happen. It can slip pretty fast here, where you can start losing money here if you start not selling enough here of the product here with the greater contribution margin here. So that's how you have to look at your different sales here based on those different contribution margins and also the number of units sold. So really what two things are going on here. We have that effects and sales mix here on our operating income. You see it dropped here because we were selling less of the units that were having a greater contribution margin. But at the same time, if we go down here, we'll see that our break-even point here is increased. So we have to sell now to break even here. Between both units, we have to sell 18,181 units. Remember, we calculated that up above here. And before, we only had to sell 16,000 units. So now we've had to move up here by what, 2,000, over 2,000 units more here, based on that sales mix here. We have to sell more, 2,000 more units here, even though we sold less here of B here. We moved from 5,000 down to 2,000, but we have to move up substantially here in units sold here in A here to make up any difference, and we weren't able to make up the difference here. We started out with that operating income based on our budgeted sales here of 3,000. We ended up here in actual sales of $1,200, and we also had to increase the number of units that we sold here between both of those products. Okay, so you understand what's going on here, and just looking at it in terms of this cost volume profit graph, you get a little better idea based on the contribution margin on a per unit basis here for each of those different products. Okay, so that'll summarize our topic.